Good morning. Today is Monday, February 6th, 2023. We are back. Tom's back. I'm back. Hope you guys had a great weekend. And I hope you guys have a great week as well. We're going to start by talking about the Bank of Japan. We're going to also talk today a little bit about some earnings results and what we got on tap for the week ahead. But let's start with Japan because the yen is sliding again. It started to slide as a result of the strong jobs report on Friday morning in the U.S. So U.S. dollar strength, yen weakness. But then also there was a report from Nikkei overnight, which says that the Bank of Japan is looking to replace Kuroda with Masayoshi Amamiya. And Amamiya is kind of the same ilk as Kuroda. So as we know, Kuroda was going to step down as the chairman of the Bank of Japan in March. And there was some concern over who would replace him because Kuroda has been exceptionally dovish, very easy with the money printing. And Amamiya is going to be of that ilk as well. So it looks like the Bank of Japan is going to continue printing money quite aggressively going forward. And that's going to be weak for the yen, strong for the dollar.
Yeah, I think it's kind of a little bit of a break from what we've seen with Kuroda stepping down. I think people were hoping that maybe they would eventually change their policy. We've seen a little bit of a change with them moving up their yield curve control, but this is probably not a sign that we're going to be in a free market system, or at least one that's a little bit more dynamic going forward.
There is some hope for the investment bankers here in the United States. We are starting to begin to see a little bit more on the deal flow, both in terms of IPOs as well as mergers and acquisitions. On the merger side, though, most of the deals we're seeing are trying to be done in stock. And if you're selling a company, you prefer to actually have the cash, at least in this market. In a market where there is uncertainty, you want cash, you want that certainty. If you are an acquirer, you want to pay with stock because your stock is probably a little bit depressed. You don't want to really part with your cash right now. So you don't want to part with a low valued currency, i.e. stock, to purchase another company. You'd much rather pay with stock than with cash. So we're beginning to see some of those deals, although we're moving the deals forward, they're not getting through to the finish line. So Newmont, which is a gold and copper miner, they are bidding for the Australia gold miner Newcrest, and that would be an all-stock deal. But Newcrest is holding out. Over the weekend, Newmont upped its offer by about 5%. But again, this doesn't really do anything because if Newmont, the size of the combined enterprise is still the same in the eyes of the market, you're just shifting how that's being paid. And if Newmont says it's going to pay 5% more in stock, well, that means that Newmont stock is going to go down. And you're seeing that this morning. So even though Newmont ups its price in terms of the number of shares it's going to give, Newcrest share owners wouldn't get any more. So ultimately, Newcrest needs stock, needs cash, but Newmont is continuing to look to buy in stock. And then Public Storage is looking to buy its smaller rival, Life Storage. This is one of those storage real estate companies. Life Storage has previously said it isn't for sale and that the latest proposal is, quote, substantially similar to the earlier one in December. And it is at a 17% premium to the current price for Life Storage, but again, it's all in stock. And so you want cash, you want to cash out. You don't want to take stock in another company right now. And that's what Public Storage is trying to do. That's what Newmont's trying to do. And then we also see this dash for cash in the IPO market. Panera, Fogo de Chao, and Cava are all expected to file their IPOs in the next few months. So, Tom, I would just say to you, do you think this makes sense, especially with funding markets where they are on the debt side, that people would prefer to get as much cash as you can, either by selling stock or by doing a deal where you spend your own stock and not cash?
Yeah, I think that it's tough because if you're Newcrest, you're basically it's a tough sell to your shareholders, even to your board, to say, hey, let's move from a concentrated position in our own company to a concentrated position of a company that's buying us. You don't really have that that exit that you're looking for. And I think that's why we're seeing a lot of pushback, because I mean, people are worried that the stock market is, either faltering, or there's a lot of places where we're seeing some big blowups. And we saw this morning The Children's Place, which is like a children's apparel company, came in and warned that they're going to, not only they're going to lose money this quarter, but they were going to lose twice as much money as they thought. They're going to lose like $4.50 a share. And so people feel vulnerable. And so saying, hey, I'll give you, take your stock and you can have mine, is not really a great bargaining chip in this environment, just because, you never really know what the financial stability is of the company that's buying you, and buying a company usually puts you on the back foot, at least for the short term. So I think that's what we're seeing. And we were talking this morning about how there's so much mixed news where you're seeing companies getting, absolutely crushed, like this Children's Place situation or Bed Bath and Beyond. And we're talking about how that this is a stretch, so stay with me here. But I was telling Ben that I was listening to a podcast where they were talking about the Tasmanian tiger having gone extinct in Tasmania has caused widespread problems for the wombats there in their mange levels. Like, they're just like super diseased. There's too many of them. There's no predators. And so they've just exploded, and now they're all sick. Well, I think that basically what we're seeing here is that higher interest rates is the apex predator. We're seeing, a situation where there was no apex predator. We've got a lot of companies. Some of them are healthy, some of them are not. And so now the apex predators come back in. And so the one with the weird leg, or the one that can't run as fast, those companies are getting eaten up pretty quickly. And so I think that's what makes this such an interesting environment. So I think that, if you're taking on new financial instability by merging or buying, and you're not doing it with cash, that's great for you, but it's bad for the company that's being acquired. It puts everybody in a bad spot, and potentially puts you in the teeth of the apex predator. So
yeah, you need cash right now. You either need cash on your balance sheet, or right now, or you want to have a business that generates very strong cash flows, preferably both. But if you don't have either of those, that's not good. And that's where Children's Place is right now. Unfortunately, they have about $500 million in debt, but they also have a $500 million market cap. So that market cap is going to go down 15% today. So they're going to be very over levered. Children's Place will be. Do we have some other companies reporting earnings this morning? Tyson Foods and Cummins. In terms of Cummins, the engine maker, they reported solid revenue results. I thought the earnings were a little bit soft. I'm not as familiar with the financial picture on Cummins as I am with many other companies. But what I would say is that they assert that demand will remain strong in most of our key regions and markets, especially in the first half of the year. And I think that's generally what we're seeing in terms of the demand environment for more of these industrial type companies. In terms of Tyson Foods, Tyson, which was a pandemic beneficiary, really is getting hit hard this morning. They do have some weaker operations, but the two big takeaways I would have from this is that price inflation is decelerating at a fairly significant clip, and you're seeing consumers switch from higher priced products to lower priced products. For example, we're seeing consumers shift from beef and restaurants to lower priced areas like chicken and retail. So if you look at the numbers, chicken volume accelerated from 1.1% to 2.5%, while beef volume decelerated from 5.1 to 2.9. They also are seeing big price declines on beef because there is softer domestic demand for beef products. So basically, all this amounts to Tyson really getting a little bit more squeezed on margin as consumers shift to cheaper meats and potentially alternatives as well.
I think this kind of plays in. We talked a little bit about it with Procter, I guess it was last week, maybe 2 weeks ago, where companies that have been forced to raise prices and have crushed on that, they just continue to move prices up and up and up and up and continue to make a lot more money. Suddenly they're seeing that's not a strategy that works anymore. And people are moving their money around. And so, maybe consumer facing, staple-y kind of stuff, Tylenol, beef, these things that were really bought up during the pandemic is probably something we need to shift away from going forward, because they don't have that power anymore.
Yeah, you're shifting more to acetaminophen, the generic. You're
Correct,
shifting more to chicken.
Yeah, you're switching from Target to Walmart.
Yep. All right, the week ahead. So we already had Tyson and Cummins this morning. Tonight we have Skyworks, which will be, I'm not going to say it's going to be meaningless, but it won't be as meaningful as when they report before Apple because they're so levered to Apple. They're a provider of radio frequency chips for the iPhone maker. Tomorrow evening, though, we do have Chipotle. Wednesday evening, we get Walt Disney. And then Thursday morning, we have a bevy of companies, including Pepsi and Kellogg. Those will be ones that I'm watching closely, especially Chipotle and especially Disney tomorrow night and Wednesday night. Disney, of course, new CEO last quarter, got the old CEO fired. So this one will be an interesting one. And Chipotle must be seeing pretty strong demand because they just hired 15,000 workers. And if you look at the prices eating out anywhere else, Chipotle is actually a reasonably priced alternative, as crazy as that sounds.
Yeah, things have gotten out of control in that space. In terms of what I'm looking for this week, we've seen a lot of debt deals hit the line this morning. We're seeing like Oracle's putting out a $5 billion issue. So I wonder if that indicates that maybe we're at a low point in rates. We're seeing a little bit of a sell-off, but usually when you see some of these higher credit quality tech names jump in and start issuing a bunch of debt, that usually means they think that rates are going higher. And so that's something to keep an eye on this week too.
And the government's auctioning off money too.
Yeah, we've got treasuries. Yeah, so we've got a lot going on in terms of new issuance on bonds. So interesting to see, kind of where we end up at the end of the week. Now we've had that rate hike come through. We didn't really see much of an impact, but we're starting to see stuff tick up today, and I think that's going to continue for this week.
I think there's a concern that more inflation's coming down the pipe, and I think there's increasing nervousness as to the Valentine's Day CPI report.
Yeah,
so
I agree.
Hopefully that it's a Valentine's Day full of love and cheer, but at least as far as markets are concerned, they're concerned it's not going to be such a great day. And then tomorrow, of course, will probably take the cake. Tomorrow at noon, we have Jay Powell. He's giving a speech in Washington, D.C. He's going to be asked to elaborate on some of the things from his press conference last week. And I would expect that he probably doesn't say much different, but he could. And so that's something we'll have to watch as well.
Yeah, I think the big takeaway, I think, from last week, and we kind of highlighted a little bit in the market memo that went on Friday, is that the read was very dovish, but the reason it was dovish is because Jay Powell said we're going to get a lot of data before March. The problem is if that data is not in line with what they want to see, that could flip on its head very, very quickly. So I think that the danger still remains that they could continue to raise rates through the summer should that data be particularly poor. If CPI comes in hot, if jobs reports don't look like they want them to, we could have some real interesting markets over the next couple of weeks.
All right. Thanks, Tom. Thanks everybody for joining us. We'll see you tomorrow morning. Have a great day.